Hello and welcome to Morningstar. I'm Emma Wall and I'm joined today by Ian Sims, Chief Investment Officer for Colchester Global. Hi Ian.
Hello Emma.
So where can we find value in the bond market right now?
Well, I think that really depends on your expectation, of course. If we're talking of value as one might have traditionally thought of it as 5, 6, 7, 8% coupons and 3, 4% real yields, that's obviously near enough impossible in today's market unless you try to do something which would probably be too clever for your own good. But in terms of keeping things simple, all we can realistically do as investors is to deal with what we've got. And what we've got is largely determined by the central banks, by the economy, things that are outside of our control. So it only makes sense to look at things that are inside of our control. And as global investors, unfortunately we live in a world now where we can deploy capital which makes most sense for investors all around the world. We're always making these trade-offs, these decisions about credit ratings, about yields, about inflation in countries, about the amount of debt they have, about the risk of default and so on and so forth.
I think that's a really interesting point because people have been forced up this yield curve. You know, as you say, 7% once was attainable on cash not that very long ago, is now pie in the sky. And so people have been forced to sort of look to high yield bonds, look to emerging market debt in order to get that income. How do you balance that sort of risk and reward?
Well, we don't try to do that, frankly. I mean, I think that's one of the biggest mistakes investors can ever make, to say, well, I need 5% each year, so I'm going to do something which gives me 5% yield each year. It inevitably drives you into things you really shouldn't be doing on a long-term basis. And of course, this is how bubbles start, by too many investors trying to achieve the impossible. So I think just be realistic. It is what it is. And the yields are not awful on a real yield basis when you look particularly outside the G3.
Because inflation is so low.
Inflation is low, yeah.
So where are you finding that then? Where is the sort of perfect blend if that's achievable?
Well, I mean, we're looking outside the G3 now. We certainly enjoyed the Eurozone ride when it was happening, but it's over in our opinion. We tend to look elsewhere, even though yields aren't particularly high. The Australian, New Zealand markets still look as if they have some added value to us. Within Europe, probably Norway is the only place we put money. But outside of that, then of course, it's the emerging market countries or the better quality emerging ones. And I know this has been a story for a while, but it's not been our story until recently. I think you only started to see clear blue water between the emerging market bond, local government real yields and the developing world around about the beginning and middle of last year. But now it's clearly there.
Ian, thank you very much.
Thank you, pleasure.
This is Emma Wall for Morningstar. Thank you for watching.